Certainly, again, thank you for being here. Recognition. Thank you very much again to our sponsors, National Commercial Bank, NCB Capital Markets, who have been with us on this journey for several years. And we thank them for their support. And we really are indebted to you for assisting us in carrying this important message every quarter. We also want to specially recognize Managing Director of NCB Capital Markets, Chief Executive Officer, Mr. Angus Young, joining us in this capacity as Managing Director for the first time. And I thank you very much, Angus, for being with us.
Thank you, Andre. Good morning, everyone.
Also, our main presenter, Mr. Don Anderson, Executive Chairman, Market Research Limited. Thank you very much again for the hard work and the work in the field that put this document, this presentation together. And to our special panelist, Mr. Wayne Chen, President of the Jamaica Employers Federation, and of course, Dr. Marlene Streetforest, Managing Director of the Jamaica Stock Exchange, who is here at least twice a year, especially at the beginning of the year, to tell us all that is going to happen in the crystal ball for 2024 and beyond. Welcome to you all. We will facilitate question and answers in the Q&A at the end of the presentations. If you could just type your questions in, and we will try to leave some time at the end to have your questions addressed by any of the four panelist presenters. We will also at the very end have a customer feedback survey, which will ask you to take 2 or 3 minutes to complete, just so that we can continue to serve you efficiently. All right, with no further ado, as we're going to be very efficient with our time today, I'm going to ask Mr. Angus Young, Chief Executive Officer of NCB Capital Markets, to make his presentation.
Thank you, Andre. And may I ask the team to share the presentation? Can we move to presentation mode, and can I have a confirmation that we're all seeing the presentation? Okay, thank you. Okay,
yes.
Good morning, everyone. My name is Angus Young, CEO of NCB Capital Markets. Delighted to be here this morning with all our panelists and our guests. What I would like to share with everyone this morning is some insight into the current markets, the scenarios, and what to expect ahead, themed bull versus bear. So without further ado, if we can go to the next slide. Thank you. So central banks across the globe have resorted to tightening monetary policy to contain elevated levels of inflation. And after a year of rate hikes in 2022, the BOJ has kept its policy rate at 7% throughout 2023 as inflation cooled. Similarly, the Fed opted to maintain its benchmark rates after 11 previous hikes from March 2022. We are forecasting possible cuts in interest rates in late 2024 amid moderating inflation and a cooling economy. Despite the recent uptick in inflation for December 2023, inflation figures in previous months have been promising. The BOJ has also taken steps to limit the upward pressure on the exchange rate, which in turn limits the pass-through effects of imported inflation. The BOJ has had 51 auctions in the market since March 2022, injecting $1.44 billion into the market and significantly reducing J-dollar liquidity. It's very important to note that local inflation peaked in April 2022 at 11.8%, but is now within the targeted range. This is good news. Next slide. DTI's current account balances at the Bank of Jamaica are an indicator of market liquidity and have declined significantly, coinciding with interest rates. So with interest rates via monetary policy being very elevated, we have seen significantly tight liquidity within the market. For example, your BOJ 30-day CD rates have increased from 2% in September 2021 to 10% in the December 2023 auction. Now, with inflation coming closer to their respective targets, both the Fed and the BOJ have paused policy rate hikes, like I mentioned before. Next slide. Now, a high interest rate environment depresses valuations. What does that mean? The valuation of, let's say, a stock, a share, is really the present value of the future earnings of that company. And that present value is calculated using a discount rate. When interest rates are high, that discount rate is also elevated, and therefore you end up with a lower valuation. So with this high interest rate environment, valuations become depressed. And of course, that creates headwinds for the stock market. So despite strong year-to-date financial performance and promising growth prospects from some companies, the market is still in the doldrums, reflecting a weak market sentiment given high yields on money market instruments and tight liquidity. So if investors can achieve higher yields on money market instruments, which tend to be, very short duration, the motivation to take elevated levels of risk by buying equity, etc., weans a bit because they're being compensated for much lesser risk. So that creates some of the headwinds for the stock market. So the stock market has continued its downward trend and to reach levels not seen since August 2018. The JCC market, main market, has gone down approximately 22% and declined by nearly 11% in 2023. This also, of course, leads to a slowdown in IPO activity and weak secondary trading activities. Now, with valuations being depressed, you're going to find that potential primary issuers on the capital market, both in the debt and the equity space, would tend to be a bit bearish because valuations are down, which means they will get less bang for their dollar, so to speak. Next slide. Thank you. So favorable macroeconomic indicators, including cooling inflation and strong demand in key sectors like tourism and manufacturing and distribution, were not enough to offset the impact of elevated interest rates and tight Jamaica dollar liquidity. Most main market sectors declined. Financial stocks were particularly affected, given that most of their earnings and asset values are directly influenced by interest rate movements. The financial sector stocks lost 15% in market value in 2023 and lost 9% in 2022. Next slide. Now, with higher interest rates, main market PE multiples have been declining, even with high-performing sectors. So main market PE multiples trended down despite an uptrend in earnings, suggesting now, this is where things get a bit exciting, suggesting now that there are many buying opportunities in the market. So manufacturing and distribution and the entertainment sector companies had a stable upward trend in earnings over the period. It also suggests that the downtrend in PE multiples is driven by lower valuations, which I would have spoken towards before, implying that companies with healthy earnings should see improved PE multiples once interest rates come down. So it is the low valuations in the face of healthy earnings growth in key sectors that would make the stock market attractive, not just the former by itself. So what we're building towards now is an environment of laden with value proposition, because earnings are improving, PE multiples are down. So the value proposition is growing. Next slide. This slide really goes into some market data that suggests the stock market's performance is in contradiction to corporate earnings, which is what I would have alluded to in the previous slide. So earnings overall are up and trending positively, but the stock market performance is going in the opposite direction, which is a contradiction. Again, this is what is creating a growing value proposition from the bear moving into the bull. And I'll speak to that a little bit more as we go forward. Next slide. Because of this dynamic, Jamaica Stock Exchange IPO activity has declined from a peak of 9 in 2019 to just 1 IPO in 2023 and compared to 6 in 2022. The slowdown underscores weakened sentiment from both the issuer and the investor. You see, issuers are hesitant given the low multiples and are opting to raise private equity immediately to do so in the future when markets are more favorable. So if there is a need for equity in the immediate, because of the lower P multiples on the public market, we are seeing issuers accessing private equity because there's a need with the view that it will go public when the more bullish markets return. So it's a balancing act for issuers. Low multiples are more attractive to investors, but may affect the issue size and the percentage carve out that issuers can and are willing to raise. Lower PE multiples lead to lower company valuations, meaning issuers need to give up a higher percentage of their company to raise the intended amount of capital. Alternatively, they can opt to raise less capital or wait until market conditions are more favorable. However, quality, fundamentally sound IPOs will continue to find support in today's environment. Next slide. The World Bank projects that the Jamaican economy will grow by 2% in 2024, a revision of 0.3 percentage points above the 1.7% projected in June 2023. This will be driven by an increase in government spending and more investments as monetary policy eases. Local unemployment continues to decline and now stands at 4.5%, which I do believe is a historical low for Jamaica, indicating that we're in a very tight labor market. The risk then being that any sort of robust growth going forward would find that there would be potential talent deficits to support it. And we expect that unemployment levels will remain low in 2024, led by stronger performances from tourism, but also some of the other sectors. The cruise industry is recovering well, and the government of Jamaica has slated plans to expand the BPO sector, which also augurs well for employment. Now, low employment rates should support private consumption, corporate profits, economic growth, and investor confidence. Additionally, wage increases in both the public and private sector should also strengthen consumer spending. Next slide. Now, amid aggressive policy tightening, which is the monetary policy of increasing interest rates, tightening liquidity to cool inflation, and declining global commodity prices and easing of supply chain pressures, we see inflation starting to normalize. Local headline inflation fell within the BOJ's range of 4 to 6%, twice since April 2023. Headline inflation in November and December notched above the bank's target range of 4 to 6%, following 2 consecutive months within the range. However, the Bank of Jamaica has regarded these temporary fluctuations driven by the continued impact of the PPV taxi fare increases expected up to March 2024. Without these effects, headline inflation would have been within range. Also, core inflation is in range and well below the peak of April 2022. Business expectation for inflation declined to 8% in September 2023 from 8.8% at their previous survey in July 2023. Our position is that provided that inflation continues its downward trend, absence of any systematic risk, monetary policy action should become more relaxed in the following quarters in 2024, which will likely improve market sentiment, providing opportunities for capital appreciation in the stock market. With inflation subsiding, and I think that this is going to be moderate, not knee-jerk, it opens the door to a lower interest rate environment. Amid a downturn in inflation, the rate pauses from the BOJ and the Fed, the industry is forecasting rate cuts could start as early as mid-2024. We are in the same camp. We believe that unless there's a significant increase in inflation, rate cuts should start in mid-2024 if prices continue to trend downwards. This, of course, augurs very well for stock valuations, as lower interest rates typically lead to higher company valuations, as well as higher PE and PB multiples. Our conservative assumptions see the potential for up to 50% in capital gains in the sector PE, reverting to 2-year averages. Next slide. Thank you. A soft landing in the US, cooling inflation, and an accommodative stance by the US Fed, with at least a couple rate cuts anticipated in 2024. We predict positive effects should translate into the Jamaican economy, tailwinds for tourism demand, less imported inflation. The interest rate differential gives the BOJ more room to cut interest rates. Local companies continued earnings momentum and proactive efforts to return shareholder value via dividends, share buyback programs, etc. Greater earnings momentum for most sectors, including financial services companies. Next slide. So what we're seeing going forward now is, with inflation seemingly coming under control, with somewhat accommodative stances by the regulators where monetary policy is concerned, we are seeing perhaps an inflection point, and there is optimism going into 2024, because as interest rates trend downwards, once they start to trend downwards, as the raises in interest rates have paused, the valuations are going to improve. Earnings are already on an upward trajectory. We do believe that the IPO activity would start trending upwards as companies come back to market to raise capital, because interest rates are lower, so the cost of capital is lower. And of course, we see several strong, fundamentally strong companies rebounding on the stock exchange in 2024 because of these expected improved valuations. Next slide. Now, what this says is basically our bullish outlook for stocks augurs well for stock valuations, as lower interest rates typically lead to higher company valuations and multiples. Now, what I would like to share with my fellow panelists, and of course all of those logging on, is that our view is that cash is king. We're seeing a buyer's market develop, and we ought to be leveraging cash to begin to take advantage of the opportunities in the market. And I would like to end my presentation with one of my favorite quotes, which goes as follows, and which really ought to reflect now the turning of the tides, which I've tried to convey to all our panelists and listeners today. And this quote is, "When everyone is fearful, be greedy. And when everyone is greedy, be fearful." So, fellow panelists and our listening audience, we are seeing 2024 as a period of time where we want to see the markets change. And this is really driven by getting inflation under control, more accommodative stances where monetary policy is concerned. Said another way, hopefully interest rates moving downwards, cost of capital goes down, capital market activity reignites, both in the debt capital markets, both in the equity capital markets. And where the market is priced right now, we see a significant buy opportunity in the immediate, because with the turning of the tides, the company valuations and multiples would trend upwards. So thank you everyone this morning for listening in. And of course, when we get to the Q&A session, I would be more than happy to attempt to answer any questions that we may have. Back to you, Mr. Goodin.
Thank you very much, Mr. Young. Well done indeed. You have a very good presentation there. So your suggestion really is that this is the time to buy, although the market still seems to have that wait and see approach. Everybody wants somebody else to go first before they they jump in. But I would certainly agree that there are opportunities now, and there have been. And Dr. Marlene Street Forest, who has been at this game for a while, and we have all seen this cycle before.
Yes.
And we know that the market operates in cycles. So what I'd be very interested in seeing, which I think will come out in our discussion shortly, is the correlation between market performance and consumer confidence, or the lack of correlation. Over the months, there has been an inverse sort of relationship. But we'll speak about that later, because now we will want to hear the facts about what happened in the fourth quarter of 2023, as Mr. Don Anderson, Executive Chairman, Market Research Services Limited, was in the field from September to mid-December. We've been doing this since 2001, so we have a lot of data, and certainly any of the participants online who would want to subscribe to that database, which is very useful for proper planning, and you will see in there the trends and how the indices correlate to economic performance, and for that matter, stock market performance. So anyone interested in subscription to the data, certainly you can contact the chamber. With no further ado, I would ask Don Anderson to proceed with the presentation of the fourth quarter business and consumer confidence indices. Over to you, Don.
Thank you very much, Andre. May I say good morning to all the panelists and to all the participants. It's always a pleasure to make this presentation. We look forward each quarter eagerly to what the findings are, and I'm very pleased to be able to present them this morning. It's important, as usual, to give you and your participants a background to this study. We have, as you indicated earlier, we have been conducting the study since 2001. So we are now in our 23rd year. Every quarter, we might have missed one, I believe. So we have certainly over 80 quarters of data. And I'm glad you urge persons to seek to get a hold of that, because it does give you a fairly long time series from which you can evaluate. And therefore, as we know, trend data is the best predictor of the likely outcome of events, right? We interviewed, as we normally do, 600 persons across the island. That was our target, 600 persons across the island for the consumer phase. Now, oversampled by 10%, and therefore we would have in excess of 600 interviews, which is the basis on which we have generated the data. For the business side, we interviewed 100 businesses of all different types. So it is across the socioeconomic, not socioeconomic, but the industry type. And therefore we have, again, in excess of 100 interviews from businesses, large, medium, small, from which the data has been generated. The fieldwork, as you indicated, just repeating this, between September and December of 2023. So what have we found? And I'm now going to share my presentation. We hope this will really be very instructive in terms of what has come up and what is likely, therefore, to happen in the next quarters during 2024. So these are just our opening slides, and we now go to the very first piece of data, which talks to really what has been the pattern. And we can see we've plotted this data from 2001, and therefore we have a very long time series of information. In the fourth quarter of 2023, business confidence went up by 8.5 percentage points, up to a index to 2019. And we recognize that even though this represented a significant increase in consumer confidence, it is nowhere near the peak which we recorded in 2019 at 183.4. One may say we're getting back there. All right. So whilst there was this 8.5 percentage increase in consumer confidence, and it continued a sort of pattern of improvement in the confidence of consumers, it is not back to the immediate pre-COVID period in 2019. But it does represent a significant positive shift from the recent lows of 120. If we look all the way back into 2021, clearly, when COVID was probably in the midst of its impact on the economy and on the country, the index was 120. So to be up to 174.7 now over a 24-month period really represents something like a 45% improvement in business confidence over a 24-month period. So it suggests that consumers are beginning to feel that we're moving out of the crisis of COVID. But what are the drivers of this? And we therefore want to drill down into looking at some of the factors that feed into this whole confidence level that consumers actually exude. Let's look, for example, at how they see current business conditions. There has been growth in consumer confidence of current business conditions, with an increase from 15.4% in third quarter 2023 to 18.5% in the fourth quarter just concluded. It's a little bit better than it was when we compare that overall consumer confidence and consumer view of current business conditions, because at the fourth quarter of 2022, that confidence level was 15.3% who felt that business conditions were good. Moved up to 15.4%, very small movement in third quarter 23, but in a way jumped to 18.5% in the fourth quarter, representing therefore a noticeable improvement in the way consumers feel about current business conditions. We can look at the other percentages. The average, those who felt that current business conditions were average in quarter 4 2022 was 66%. That moved up in the same period for 2023 to 69.2%. And therefore, again, we can see here is another indication that consumers are feeling a little bit more comfortable about current business conditions. And that is feeding into that 8.9% improvement in overall consumer confidence in the way in which things are going as far as businesses are concerned. So this is their perception of businesses, right? They are not hands-on in business, but they look on, and the impact that business have on them definitely plays out in terms of how they feel about current business conditions. And this is reflected in this particular chart here. We want to now look at something which is very, very instructive, because how do they perceive current jobs, for example? We make the point that consumers have never, ever been really comfortable at the level of job availability. So that for them, jobs have never been plentiful. As a matter of fact, generally we are looking at about 8%, 9%, 1 or 2 quarters where it got above 10%. What are they saying? In the fourth quarter of 2022, 11% of all persons that we interviewed felt that jobs were plentiful. 43% thought that jobs were adequate. And 46%, the largest single factor here, said that jobs were in short supply. We fast forward to the third quarter of 2023, and that number fell to 9%. 9% of the persons that we interviewed said jobs were plentiful, which is a fall of 2 percentage points over the fourth quarter of 2022. But that began to move up. And in the fourth quarter of 2023, 10.4% of all persons interviewed said jobs are plentiful. So that's averaging around about 10 percentage points, which is fairly consistent with what we have seen over the previous years. jobs have never been plentiful as far as consumers are concerned. Okay. Some of them feel that consumers are adequate. And when you look at that, 43% in the fourth quarter of 2022 said that jobs were adequate. That moved up to 43.6% in the third quarter of 2023, but shot up by 6 percentage points, just under 6 percentage points, to 49.3% who felt that jobs were adequate. Again, therefore, when you look at those who felt that jobs were in short supply, those numbers are trending down from 47% in the third quarter of 2023 to 40% in the fourth quarter of 2023. So we can see that consumers are feeling better, marginally so, about the availability of jobs. And this is another issue, this is another factor that is helping to drive that consumer confidence of 8.5% as we saw previously. Okay, so that's worthy of note that consumers are feeling, certainly, when we look across the 4 quarters prior to the fourth quarter of 2023, they are beginning to feel better about the availability of jobs. All right. Now, what do they expect in terms of the business climate? Do they expect business to get better? Do they expect it to remain the same or worsen? And again, their evaluation of this particular matrix does feed into that 8.5% who feel that business conditions are worth looking at. They're feeling more confident about their own situation and are therefore, as the data will eventually show you, more confident about expenditure, about acquiring. So what does this particular chart, expected business condition, tell us? In the fourth quarter of 2022, 32% said that they expect business conditions to get better. But we note that in the third quarter of 2023, that had fallen to 24.6%. All kinds of factors taking place for the first 9 months of the year drove this kind of impression that business, they don't expect business to be as good as it was in 2022. But note that when we come to the fourth quarter of 2023, the number of consumers who currently feel that business conditions are going to get better rose from 24.6% to 35.3%. So we're bearing in mind that this is the Christmas period. This is the last quarter of the year, and all kinds of things are happening. People are expectant. And I think to a large extent, perhaps there isn't sufficient concrete evidence to justify the 8.5%, but we're finding that consumers are beginning to think, certainly during the fourth quarter of 2023, that businesses are going to get better. Business climate is going to get better, and therefore this is a good opportunity for them to look at what is going to happen as far as their own situation is concerned. We note also, therefore, expectedly, a concomitant decrease in the number of consumers who feel that business conditions are going to get worse. So in 2022, fourth quarter, that number was 22%, roughly the same third quarter of 2023, but fell to 16.5% again, which accounted for that increase in the number of consumers who feel that business conditions are going to get better. They expressed that in the data collection that we completed during the September to December period. So that right through, there's a certain degree of consistency. Consumers are expectant. They're beginning to feel a little bit better about job availability. And as a result, what we find is, how do they reflect upon the whole situation in terms of jobs? Let us look at the third quarter and the fourth quarter of 2023, first of all, because consistent with a fall off in what they consider to be the business climate, worsening, probably not as good as it was in the fourth quarter of 2022, 25% said that they feel that jobs are going to be maybe a little bit more available. That was 25.7% in the third quarter of 2023. That, of course, we noticed down from 32.1% in the fourth quarter of 2022, consistent with that fall off in the expectations as far as businesses were concerned. Same period, we saw that fall off. Again, consistent with the pattern in terms of how they expect businesses to move in the third and fourth quarter, 30% now say that they expect jobs to be more available. So again, we're seeing consumers beginning to feel more comfortable, more in tune with what's happening in the economy and believing that the economy is going to improve. Businesses will get better, and therefore, as a result, there is an increase. There's an uptick of 30% to 30% who expected jobs to become more readily available, and therefore a concomitant fall off in those who expect that the job situation should become worse. So consumers are, in fact, generally exuding a certain degree of confidence throughout the evaluation that we just completed. So what does that mean for changes in household income? And this might be counterintuitive, because one would have expected, therefore, with this sort of buoyancy in the mental approach or in the kind of consumers are looking at businesses and the economy, substantial increase in my household income. Not so. As a matter of fact, when we compare fourth quarter 2022 to fourth quarter 2023, we realize that there is a marginal decline, almost negligible, but we need to note a decline in the number of persons who believe that their household income will increase. So that has implications clearly for plan to purchase. But we just need to look at that and digest this piece of information just a little bit more. In fourth quarter, 50.1% said they expected their household income to increase. That fell by 0.2 percentage of a point, 0.3 percentage of a point, down to 49.8% in the fourth quarter of 2023, up again marginally by 1 percentage point from the third quarter. So even here we see a marginal, really minimal improvement in how they perceive their household income and what is likely to happen over the next year, all right? And therefore we can see, if you wish, a flattening between third quarter 2023, fourth quarter 23, in those who felt that their household income would not change, those who said it was going to be the same. So just bear in mind that pattern that we're looking at. They believe that conditions are going to be better generally. They believe the businesses will improve, but they don't really expect any substantial increase. As a matter of fact, there's a slight fall off from the corresponding period, fourth quarter 2022, in the number of persons who believe that their household income, combined household income, will change. What impact, therefore, on plans to purchase? This is something that we've monitored consistently, and we've used 3 variables: intention to purchase a house, intention to purchase a vehicle, intention to take vacations. And let us look at what the fourth quarter 2022 data said. 11% said, based on where we were in 2022 fourth quarter, I intend to purchase a house. 18% said they intend to purchase a vehicle. And 28% said, I'm prepared to take a vacation somewhere. Let's look at 2023 third quarter and 2023 fourth quarter, because that number who felt that who said they were going to purchase a house moved up to 13.2%, moved up again to 15.7%. So I think this is good news for NCB. The intention to purchase in all 3 categories is up, and up substantially, as we will see in one particular category. What about vehicle purchase? That moved from 18.3% fourth quarter 2022 to 23% in third quarter 2023, up to 26% in fourth quarter 2023. And when we look at vacation, that is a substantial area. Again, perhaps because it is relatively less demanding in terms of cash outlay or financial outlay. Perhaps. 28% said in 2022 fourth quarter, I intend to take a vacation. That moved up to 38.3% in the third quarter of 2023, and further, larger single increase up to 44.1% in the fourth quarter of 2023. So I believe all the threads are hanging together now very carefully. If we go back to look at how they feel currently, 8.5% are more confident about themselves right now. Why? Well, they believe that current business conditions are good and going to get better. They expect the conditions are going to improve. They believe businesses are going to, work more efficiently, and they expect, therefore, a marginal increase in their household income. this feeds into, as far as they are concerned, an intention to purchase, an intention to spend. And here is what they say they will spend their money on. Generally, these are the three categories that we have profiled and targeted and looked at every time. And we therefore, as we indicated, have a very long time series. It is generally the same pattern. Vacation tends to be the largest single expenditure that they're contemplating. So very interesting data. Consumer confidence is up almost 9 percentage points. And these are the variables that are driving that kind of confidence across the last quarter. We want to delve a little bit more into business conditions. We realize that in fourth quarter, 27.2% said they expect business conditions to be better. All right. Now, what is driving that? The largest single factor, again, these are the consumers we're talking about. They're just optimistic. They have a good feel that things are going to change, things are going to happen, things are going to happen good for them. And therefore, they're pretty optimistic. What else? They believe that entrepreneurship is on the rise. And we're seeing that. A lot of new businesses are being opened up by persons who are were either displaced during COVID or certainly finding the urge to push towards their own businesses these days. And that they're identifying as one of the factors driving the confidence that business conditions will get better in 2024. The economy is showing signs of improvement. This is their perception, right? And the indications are, in fact, buttressed by data that we looked at from Angus, where the inflation is down, and we can see a number of other factors that are driving how consumers feel about themselves going into 2024. New investors and new investment is coming in. They see that. They may not be aware of what all these are, but this is what is happening around them. These are the things that are buzzing around, and they feel that that is likely to drive the situation some more. And of course, we can already see improvement in some sectors like the tourist sector, which they point to quite clearly. So these are some of the factors that are driving consumers' perception of improvement in business conditions over the next 12 months. There are some, of course, who believe that conditions are going to worsen, and we therefore want to know why. High cost of living. This is the number one factor that consumers point to, high cost of living. Lack of employment, inadequate employment. Despite the fact that data suggests that there are 4.5% unemployment, they're saying there's lack of employment. Increase in crime. Government not assisting enough. And the whole question of the foreign exchange fluctuations, they believe, are round out the major factors that they identify as their reasons for saying that business conditions will worsen in the next 12 months. So they mentioned high cost of living. And this is a piece of data that we've been accumulating and collecting over the last couple of years, not as long as 23 years, but over the last 3 or so years, we've been targeting, we've been looking at this piece of information. We've been looking at how do people feel about prices compared to last year. And the data is consistent. 76% of the persons that we interviewed say that prices of items normally purchased, meaning their household, the things that they require for their daily household needs, have gone up significantly. 17% said it has been increased. These have increased moderately. So we have basically 9 out of 10 persons who cite an increase in cost as one of the factors, obviously, that they are bearing in mind constantly. The other 7% thereabout are really, negligible, clearly, compared to that 93%. And that the takeaway from here is that the consumers are consistently reporting that prices for them of items that they buy to maintain themselves and their regular disposable income and to keep themselves going within the household, these prices have gone up significantly over the last year. So we can see exactly what the challenges are that will impact consumers over the next 12 months. Having said that, we then asked consumers, well, what do you see as the most critical issue facing the country? Perhaps not surprisingly, and this is all verbatim, this is all unprompted, nobody was given any answers to respond to. 70% volunteered that the big issue, the most critical issue facing the country at this time, not surprising, is crime and violence. But note that this is 12 percentage points more than it was in third quarter of 2023. So that in the last quarter of 2023, there has been a serious appreciation, greater appreciation of the problem that crime actually generates. 70% now believe, up from 58%, 70% now believe that crime and violence is the #1 issue that we need to address. All others, to a large extent, pale insignificant, but we can see those going down the scale. Unemployment is next, and poverty is next. And we will see from the next chart that those are not unrelated: poverty, unemployment, and crime. This is their perception. So what do you anticipate will happen over the next 12 months? And this is probably even more worrying, because 60%, against a background where 70% believe that crime and violence is the most critical issue facing the country, 60% of those persons interviewed anticipate that it will get worse over the next year. We can't take comfort from the fact that 11% said it will get better. 60% say that crime and violence will get worse, against a background of it being the #1 problem by far that the country needs to address at this particular point in time. So the policymakers and the policy executors need to take note. So we didn't leave it there. We said, well, what do you think should be done to address crime and violence? And not surprisingly, 36, they gave a raft of reasons. Maybe 7 of them are a standout. The most telling response was more jobs for young people, 36%. Better paying jobs for the youth. So they're saying that there's a relationship between the employment of youth and crime and violence. What else are they proposing? More stringent penalties for crimes, bringing back capital punishment, clamping down on corruption, programs for the unemployed. So we're talking generally about greater employment, against the background of the official stats say unemployment is down significantly. People are citing these factors as ways in which attempts could be made to reduce the whole monster of crime and violence within the society. All right. So we're not dealing with only bad news, but again, here we talk in terms of what sectors do you think would show improvement over the next 12 months? And I think we probably want to zero in on that kind of, my color appreciation is not all that great. It looks like lemon to me, but lime green, so something like that. We look at that, and when we look across the situation, we can see exactly where they believe the greatest improvement will take place. And 36% say the education sector. We have a couple of the highs, like in the small business sector, 34%. But I want to go all the way down to the least mentioned factor. And it says that 15%, the lowest factor here, people express that that sector, the police, will improve over the next 12 months. So that's the lowest incidence of expected improvement across the sectors that we polled, which is the police. They believe that this is where the least improvement will be identified. But we can see from that where they expect changes to take place for the better over the next 12 months in the various sectors that we looked at here. We looked at the police, small business sector, government in general, health services, roadways, public transport, education sector, water supply system, and the power supply system. So that's a pretty telling piece of information. And we asked them the question because this is something that is of concern. We hear more and more talk about, artificial intelligence and so on. Will this replace jobs? There's not at this point in time a strong conviction that AI will replace jobs. 50% said their job is strongly unlikely to be replaced by technology. 18% said probably likely. But the fact is that the majority are not at this point in time overly worried that technology will replace them in their particular jobs. Comforting maybe, but it is worth noting that this is a benchmark from which we hope to be able to plot some more data as we go forward, quarter by quarter. So again, final chart on this particular segment, the consumer phase. What are the things that consumers rely on more in the future? We can see, understandably, apps on mobile phones, 76%, mobile device use of tablets and smartphones, 75%, and in decreasing numbers, online banking, 55%, online shopping, 52%, computer usage, 50%, and delivery services. So we see some new kinds of avenues opening up. We see more and more food delivery bikes on the road, and I think this is what is being alluded to here. But again, basically, people are going to be using their mobile devices far more, it would appear, than they have done in the past. All right. So people are thinking about investing. Where would they invest their money? And 26%, the largest single factor here, says that they would be going to a commercial bank, followed by credit union, and 10% would invest in real estate. There are other options that have been identified to a lesser degree, but commercial banks, credit unions, and real estate are the three that they see themselves investing in if they have disposable income to so do. All right. And I believe this is our final chart on the consumer segment here, which is a very important piece of charting because we started the evaluation of the remittance market around about 2011 when we couldn't understand some of the kind of expenditure patterns that consumers were indicating they would be embracing. So we began to look at a number of factors, and we're happy that we've started to plot. We started to plot 12 years ago the whole question of remittances because we can see exactly what has been the flow over the years. The 2021 to 2023 periods represent the lowest level of remittance inflow into Jamaica in terms of numbers of households that receive remittances. We can see, therefore, that that is coinciding with COVID and the impacts on COVID in those developed countries from which we largely receive our remittances. So what we note was that in 2021, we saw a significant dip from an average of about 35% households receiving remittances down to 29% in 2021, 26% in 2022, and we noticed a slight uptick of 2020 up to 27% in the 2023 period, which is welcoming news because, of course, remittances, we know, go to fuel a lot of expenditure, especially amongst the low middle, and low socioeconomic group, help them to meet their daily household expenditure. And in fact, this is a very important uptick of 2 percentage points, 1 percentage point only over the period, but again, noteworthy because it could be the beginning of a trend which takes us back to the average of about 35%. Now that COVID has receded, and in fact, those markets that from which we receive the bulk of our remittances appear to be opening up again, comparable to previous COVID years, and with a high, as we can see in 2016, 2017, 2018 at 36%. All right. So that takes care of the consumer phase. Note 8.9% improvement in confidence amongst consumers, fueled by generally their perception that things are going to get better, even if not for themselves, but the economy is going to get better, businesses are going to get better. And from that perspective, they expect a slight improvement in jobs, slight improvement in household income. And by those processes, they expect therefore to be able to purchase more items. So the consumers are buoyant. And it continues a pattern of improvement from 2021, where COVID hit us really hard. So I want to look now at what businesses are saying. We have found over the many years that we've been tracking this, that in a way, consumer confidence and business confidence tends to operate almost on a parallel. They tend to go up and go down, almost not to the same degrees, but in the same line. Not so in this particular quarter, because over the fourth quarter, 2023, business confidence fell by 3.9 percentage points down to 139.1. So we saw where it was moving up, but it is nowhere, it had not by any means gone back to that pre-COVID situation of 151.3, which is the highest it has been recorded for the 22 years that we've been doing this study. It's down to 139.1, and we therefore need to take a look at what are the drivers of this decline in business confidence. Bear in mind, we're talking about the last quarter of 2023. What is the actual number? The last quarter of 2023 saw a decline. But we note when we look at that 5-year pattern that the year to year, January to December 2023, business confidence is 139.7. Close to the top of 143.6 recorded in 2019, better than 2022. But for the last quarter, business confidence fell, and that fall off did not turn around that improvement that we saw in the first 3 quarters of 2023. Okay, so we don't need to note that. Slight fall off in business confidence of 3.9% quarter to quarter, but year to year, there was a 3% improvement in business confidence overall, 2022, 2023. So what are the drivers of this particular situation? And we do very much the same kind of calculation. How do firms feel about their current profit situation? 24.8% at the end of 2022 said that their profits were better than expected. That moved up to 25% in the third quarter of 2023, and even more, 26.3%, a marginal increase of 1.3 percentage points, who felt that their profits were better than expected. So not bad, eh? Businesses are feeling okay, their profits are better than they were in 2024, marginally. Those who expected it to be, or who said it was as expected, moved from 54.9% in the fourth quarter of 22 to 61.6% in the third quarter of 23, but down to 57.9% in the fourth quarter of 2023. So there's a slight increase in those who said it was better than, but those who said it was expected fell off by 4 percentage points just about in the fourth quarter, between the fourth quarter and the third quarter of 2023. But note, again also, that those who said it was going to be worse than expected, 20.4% in the fourth quarter of 2022, that fell to 15.8%. So generally there is a slight improvement in how they see the whole profit margin and their profit experience. What about investment expansion? Very interesting, because what we find is that businesses are less confident about this being a good time to invest than they were a year ago, than they were 3 months ago. In fourth quarter of 2022, 61% of the businesses said it was a good time to invest. This does not, by the way, come close to the pre-COVID periods where we had close to 70% of businesses saying it's a good time to invest. In the fourth quarter of 2022, 61.1% said it was a good time to invest, but that fell to 57.1% in the third quarter of 2023, moving up to 53.7%, moving down to 53.7% in the fourth quarter. So businesses are less confident about the economy, about the time now being a good time to invest or to expand. All right. And we could only put that down based on the other data that we have to a kind of cautious approach on the part of businesses based on what they saw happening around them and where they thought the economy was going. They do have challenges which they will identify, and which they identified and which we will share with you in the upcoming charts. So how do you feel about your own company's finance? Note significantly the changes that have been articulated by the business sector. 100+ businesses that we interviewed across the industry types. When we looked at the data, fourth quarter of 2022, 80% said that we expect the firm's finance to improve. That in fact went up to 83% in the third quarter of 2023. So up to then, businesses are saying, yeah, we believe that our firm's finances are going to be good. Remember, profit levels, etc. they spoke to, but that fell to 55.3% in the fourth quarter of 2023 amongst those businesses who said they expected the firm's finances to improve. Something drove that. All right. But it is significant to note that that fell over a period of 12 months to a very low, just above the majority, just above 50% in the fourth quarter of 2023. What about their profit situation? Do you expect it to improve? We note, despite all of that, the year-to-year situation is marginally better, but the last quarter recorded 70.5% of the businesses who said they expect their profits to improve, down from 80.4%, consistent with the changes that they expect in their finances over the same period. So they expect their finances to drop. They expect their profits to drop by 10 percentage points, fourth quarter 2023 over third quarter 2023. Right? So how do they feel about business conditions generally? And this tells you a little bit more about the story, because 53% said they expect the economy to improve fourth quarter 2022. That fell to 41% in the third quarter of 2023, but picked up 3 percentage points to 44.2 in the fourth quarter. But we note that there's a significant 9% fall off between the fourth quarter of 2022 and the fourth quarter of 2023. So businesses are concerned about where the economy is going. The largest single factor, of course, think that businesses are going to be better. The business environment and the economy is going to be better. So you may want to take comfort from that, but you cannot escape noting that a significant number of businesses believe, or few of them believe, that the economy is going to be better than it was in 2022, end of year. Consistent with how they see their firm's finances, consistent with how they see their firm's profitability. So 44%, we then filtered out that 44% and said, okay, what are your reasons for saying that the economy is going to be better? The first item that they mentioned, and these are not necessarily in terms of weight of numbers, but the 5 top reasons they gave were as follows. The economy is recovering. Some sectors will improve the economy. These are verbatim comments that we trapped and recorded. Government policies being put in place. So here they're talking to government policies impacting their performance and impacting the economy. They're being optimistic. So they're in a way not dissimilar to the consumers who really don't have a solid reason. They say, well, we're just being optimistic. All right. And this is one of the things that businesses also say. And they're believing that, some industries like tourism will rebound to the benefit of the economy. So these are the factors that they attribute to an improvement, the perceived improvement in business conditions over the next 12 months. But 22% believe conditions are going to worsen. And we need to take note of these reasons. Unstable foreign exchange. They talk about this factor consistently. The economy will not improve that quickly. So they believe that we're still struggling out of COVID. And therefore, we expect it to change over a period of time, but don't be too optimistic about it changing too quickly. High prices for goods and services, or question of the supply chain problems they're having in terms of receiving goods and services. High job loss, high unemployment. These are factors that are impacting them. And of course, the whole question of, that's the way in which people see the economy, and they're concerned generally that the economy will worsen over the next 12 months. Happily, it's only 22% of the businesses that we interviewed that have this point. We move on. This is a chart that we started to plot maybe about 5 years ago, and it was in response to questions from the audience, from the participants. Well, you say that surely it's a good time to increase capital, or we plan to increase capital, but we don't know where. And we began to plot this over the last 5 or 6 years and so on. So if we look to the extreme right, we will see the current information, year to date 2023. What are the sectors that say they will improve, they will increase their capital investment? And it's by industry type, of course. We can see standing out here is wholesale and retail, 66.4%. Followed by transport, storage, and communication, 65%. Farming and agriculture, 64%. Construction and installation, 63%. So we can see exactly what sectors are planning to increase their capital investment over the next year. This is the fourth quarter data. We compare that to 2022, and there have been changes generally across the sectors based on what's happening in the economy and what's happening in their businesses at that point in time. So we probably need to look exclusively at 2023 data, and we can see exactly what are the projections, which are the sectors that are likely to increase their capital investment over the next year. All right. We may say the one that is least indicated here, other services such as personal care and so on. But if we look at the previous year, just for a change, 2022, personal care, dressmakers, householders, hairdressers, etc., 75% of them indicated in 2022, that's where they were moving. Probably accounts for that fall off, therefore, in 2023, where 49% of them represent the lowest incidence amongst the various sectors that we polled. We have some other interesting data that we want to look at. So, what are the factors that are impacting your decision to undertake business expansion? Again, these are totally verbatim responses that we captured, and we're reporting them as we have been given them. Lack of funding, access to finance, 23%, the largest single deterrent as far as they are concerned. High input costs, supply chain challenges, cost of foreign exchange, 18%. Shortage of qualified skilled labor. It's a factor that has come up more frequently when we talk in terms of bringing in labor to supplement what we currently have. So there is a challenge, and businesses are saying we do have a shortage of qualified skilled labor. Lack of revenue, cash flow, not dissimilar to lack of funding, but it was mentioned separately, and we polled it and actually indicated it separately. High interest rates, 13%. And we can see what are the other factors. Logistics, getting supplies on time. Crime, 6%. This is not that crime is not a key factor, as we will see in a subsequent chart. But in the scheme of things, they're saying that the more important factors impacting our decision to undertake business expansion are the ones I mentioned before. Primary of which was lack of funding, access to finance, high input costs, and cost of foreign exchange being the top three. But there are other factors as we see. One of them, 1% inability to collect money owed. Here you go. So as far as you're concerned, we asked businesses, what are your views on the most critical issue facing the country? The answers they gave are very similar to what the consumers gave us. Nobody was prompted, no businesses were prompted, and as a result, we come up with a situation where 55% of the businesses that we interviewed, over 100 businesses across the industry type, indicated that crime is the most critical issue for the country to address right now. And note too, that that's a 12 percentage point change over the third quarter data. Next thing they mentioned, unemployment, pretty much the same things that the consumers mentioned. Inflation, lack of skill trained workforce, etc. So we can see that the consumers and the businesses are thinking very much along the same lines on this particular issue. What is the most critical issue facing the country? And they have articulated it as follows. All right. But before I go off, let me come back to this. Again, we could have transposed the consumer chart. When we ask businesses, what do you anticipate will happen to crime and violence over the next year? Almost the same identical percentage. 61% said they expect it to get worse. This is not good data. Against the background of crime and violence being the #1 critical issue, both consumers and businesses say they expect it to get worse. And we're talking about a preponderance, 61%, 6 out of every 10 persons that was interviewed. Okay? So what do you think should be done? And again, we talk in terms of more jobs for young people. This was one of the things that the consumers identified. Businesses are also saying the same thing. More stringent penalties for crimes, better policing, clamp down on corruption. Both businesses and consumers are concerned about the level of corruption, programs for the unemployed. We could sum that up in terms of jobs, reducing corruption, more penalties for crime as the key factors. But there are others. Programs to empower the youth, better paying jobs for the youth. So there's a strong focus on actually finding employment for youth because they believe that there's a correlation between youth unemployment and crime. All right. So we ask the same question. Which sectors do you expect improvement to be? And if we look to the extreme right, we will see that the sector that is anticipated least improvement will take place is amongst the police. Which one will it be most of all? Small business sector, 3 percentage points expected. Power supply, electricity, 3 percentage points roughly. educational sector, again ranking pretty high, 3 percentage points, water supply system, but all the way down the bottom, it is the police, and it's less than 2%, or just about 2 percentage points that expect improvement in the police area. All right. So these are important factors to note. Where are you going in terms of your technology? This is what we ask businesses. What are you likely to be shifting to or expanding upon? And they're saying social media advertising, 35%, electronic payment solutions for customers, virtual security systems, and GPS technology. So these are areas that they say they intend to expand into or improve upon by engaging more of what they currently have. New hardware, artificial intelligence, 13 percentage points, right? So that's what they expect to do and where they expect to go in terms of technology. What are your business goals for 2024? We ask persons. Not surprisingly, increase revenue and sales, 48%. Spontaneous, verbatim comments, we trap it as we got it. 42% to expand their business. So the two are tied. 48% increase in revenue and sales, expanding their business tied. Increase customers and grow their market share. Very competitive environment, recognize, and they believe that need to grow their market share. Increase their product and service range. Stay afloat, the viable. There are those who are concerned about where they are, and they say, my objective and my goal for 2024 is to stay afloat. And they may, some of those are feeding into the kind of very conservative, cautious approach to where they are currently. Complete renovation, improve quality of products and services, and so on, down to pretty small numbers, which need to be noted. But what are the factors that are going to help you to achieve these goals? Not surprisingly, again, 39% said better finances, and 21% said human resources, meaning better quality labor, more labor, and more efficient output from my human resource personnel. So that, ladies and gentlemen, participants, represents the data that we've collected and reported on. And we hope that we're able, when the time arises, to be able to respond to questions which I know will come from participants. Andre will probably, as usual, usurp the position and ask the first question. That's fine. And from all the participants, we hope that we'll be able to respond appropriately to all the questions that will have been presented to us in due course.
Thank you very much, Don. Really a lot of information there, really a lot of information, a lot of food for thought. And I can see some of the panelists making notes at some of the information. What struck me really is that consumer confidence up by 8.5%, business confidence down by 4%. On the consumer side, they expect business conditions to improve. They expect job to improve, but they don't expect their income to improve, which means that how do you close the gap? By borrowing. So that's the commercial bank opportunity there. But at the same time, the things that you're borrowing for, because the preponderance of the respondents on the consumer side say they're going to be taking vacations and buying new motor vehicles, etc. So that's definitely a commercial opportunity. But before we go into the comments from the panelists, we do have some videos, short videos, which were interviews with small businesses and medium businesses as well. General comments from consumers and business persons on the state of the economy. So I just ask our technical persons to just show those videos very quickly, and then we go into the panel discussion.
I'm Alfred Thomas, the Managing Director of Pioneer Manufacturing Distribution Company, PMD, a solid Jamaican company that is in the Jamaican landscape now for 17 years. the labor force in Jamaica is at a challenging point of Jamaica's history. How do we deal with that? We work with the Mona School of Business and the University of Technology to recruit students for internship and for us to get the right cadre of employees for the different divisions of our company. Our company look at our pricing models because we realize that Jamaicans are hurting in many instances. So what do we do? Because of the fact that, one, Chlordu is a major brand in the country, we have different sizes, and we are always cognizant of the fact that our consumers must be given competitive pricing. We also have laundry soap, bath soap, fabric softeners that are targeted to persons of the different socio-economic background so that they can buy different sizes of our product to survive the high inflation. Where do we go from here as a company? We are launching into a new area of business, wastewater and industrial water treatment, because that's a great opportunity to build our company in the next few years.
All right. That was a small business, medium-sized business, speaking about their plans to survive 2024 and their expansion plans. So you can see he's customer focused and looking to make it more affordable. Next one.
The main thing is to be more focused with my Christian life. The main thing, and to be able to achieve more for my children and my grandchildren them, and maybe other family member, other people too. You know, just want to help my family alone, want to help other people too. Maybe no, they will say sickness, you know, because even the sick, my mouth can't tell me how to do things. You understand? We can't use my mouth, and you know. So I think say it's just me myself, because the blessing I get from God, I'm just me who that try to stop myself. You know.
I would say to be better, develop myself mentally, more physically, and financially. The top 3 things that would stop me would definitely be myself. If I don't see any other obstacles in front of me like that, that I could say, yeah, this thing could definitely hinder me from achieving these goals. It's just me, and getting the right people in my corner for the financial part. Mentally and physically is really more personal development, working out, gym. So, yeah.
What we need to achieve in 2024? Well, I need to finish the project car, and finish the project car. So what we need? Money. What we need again? More money. And we want again? Even more money. That is my goal for 2024. Money. I need money.
Thank you very much. Interesting. Money. Personal development. All right. Thank you, Don, and thank you to the POW team for those videos. Now we're going to look at the panelists here. Dr. Marlene Street Forest, I'd ask you to take the first go here, looking at the business and the consumer results. Does it corroborate with what you are seeing on the ground? I saw some statistics from Angus as well relating to opportunities in the market, etc. From where you sit, do you see businesses showing the same level of caution while consumers being more aggressive? What are you seeing at your end?
Well, if you were to look at the market, and Angus has spoken about it already, just from the performance of the index, and the main index, you would have seen that there is a decline of somewhere around 8 point some %. Now, what that does is feed into what is the performance of the market. And obviously, the investors are a major part of that market. And so there is a pullback in terms of volume, value traded on the market over 2023. Now, let us look on the confidence level. I imagine that given the performance of the market in terms of the advanced decline, status of companies, we had last year 56 companies advancing. We had 81 companies declining and 2 standing firm. What that means, therefore, that there is opportunity in the market, especially from the standpoint, and we heard Angus speak about many of those companies that even have shown a decline in price, that they are doing well in terms of their overall performance. So there is quite a bit of opportunity in the market. So if we look at the confidence level, I'm expecting that we will see persons looking at the opportunities in the market and coming back as it relates to the business. So that is on the end of the consumer. As it relates to the business, what we are seeing, while there's a decline in terms of business confidence, what we're seeing is that persons are anticipating, though, that 2024 will be better because we have companies preparing themselves to come to market. Obviously, many companies are awaiting from the junior market, are awaiting government's incentive to increase the level of the amount that they can raise from the market. And that is important, and it feeds back into the survey on the access to capital, because when that is increased, we'll find more junior market companies coming to access capital. So these are some of the things that we do know will play a role in terms of persons coming back. Confidence in the market is also one that is important. And the stock exchange has been working to improve the confidence, which got somewhat eroded a bit in 2023.
Thank you very much, Dr. Marlene. Mr. Chen, consumers said they believe jobs are going to be more available. Businesses are saying they can't find anybody to hire. And at the same time, both businesses and consumers are saying that what needs to happen to improve confidence and to improve performance is jobs for young people. As the head of the Jamaica Employers Federation, does this corroborate with what you are seeing?
Yes, it does. But one thing this survey has proven to me is that perception and reality don't necessarily have to be the same. But perception is people's lived reality. The fact, just to pick a number out of the very exhaustive and excellent presentation by Don, when there is still a significant number of Jamaicans who feel, for argument's sake, that exchange rate stability is an issue, it flies in the face of the reality that the dollar has been more stable over the last 3 or 4 years than it has at any similar period in the last 50 years. But there's something that was missing from the discussion, and it was the reality that the public sector compensation increase meant 100 billion more paid out, and that is irrefutable in the fiscal year 23-24, which must have had an impact on the 100,000+ public sector workers, because you're talking about an average annual improvement of around $1 million per person, not counting the agencies. And we in the employment sector saw the push it had on wages within the private sector, because to retain talent, especially in the record low employment, 4.5%, lowest recorded ever. And on the converse, the highest number of Jamaicans employed in the formal sector ever. That's when I saw the numbers around what people intend to do in terms of buying a car, going on vacation and so on, the numbers match with the dollars that have really gone into the economy over the last year or two. So the numbers are squaring with what we see. The fact that most of the other issues, thorn issues, we have been at this for a long time. Issues that were thorny 10 years ago, 20 years ago, 30 years ago, have all receded, where crime now is 70% of the concerns and everything else is in single digits. So the numbers are squaring what we see.
Okay, thank you. There's a question in the chat, Don, which I believe is relevant to what Wayne just mentioned. The purchasing plans and the investment plans of consumers particularly, would that have been influenced by the revision of the public sector compensation to a degree to where it would influence what we saw there? I don't know if you have a breakout of whether you spoke to how many public sector employees or private sector employees you spoke to in that 600, but would the compensation plan, compensation improvement actually have some influence on what you saw coming out in the consumer result?
I think Don is muted.
You're muted, Don.
Right. I don't have any definitive information that would have helped me to comment on that. I think the time period between when the new salary things were announced, I think around about February thereabout, and December would be too long to draw a kind of relationship between the two. There must have been a number of intervening factors between then and when we did the field work. It may have been, but we don't have any data that we can substantiate that.
Okay, thank you very much. Angus, access to capital. Access to capital has come up in both consumer and business. There seems to be an opportunity there in terms of, I don't want you to tell me what you have in your order book, but are you seeing an improvement from the business side in terms of requests for capital, and likewise from the business side? And the question really comes from the statistic which shows that several sectors of the economy are in double-digit percentages of them are expecting to increase investment in their business. Is that also seen in the demand for your products and services?
I think we're I think the inflection point is not far away. When you have very, very high rates and tight liquidity, access to capital becomes very expensive. So you would find that the only people who are coming to market now are people who have maturities that they have to refinance, or people who may have an opportunity related, for example, to an acquisition where they have to act in the immediate and access capital in today's elevated interest rate environment. I think once we see interest rates tapering off, plateauing, and possibly deep into 2024 start a downward trend, I think, Andre, you will find very quickly that the return to the markets for capital would be triggered, and that you would find that the bears turn into bulls in terms of investing further capital into their businesses. Because like I would have mentioned before, once interest rates start trending downwards, the cost of capital reduces, valuations improved, and you get a bigger bang for the buck where valuations are concerned. So I think we are still in that period where we've observed that the regulators of the world have ceased their interest rate increases. And I think that once you see the first decrease in a policy rate, it will snowball from there in terms of demand, where everyone places their bets. So we're at that point where I think the majority of the market is in a wait and see mode. And I think that those investors who take the plunge now, so for example, those investors, they say fortune follows the brave. You would have mentioned earlier, Andre, those investors who place their bets now on today's valuations in the stock market would be best poised to take advantage of the improved valuations going forward.
So Dr. Forrest and Angus will both agree then that the real decision maker will be a reduction in interest rates. I'm watching CBX right now, the stock exchange's cable channel, and CNBC as well, where CNBC is saying that they're trying to predict exactly when the rate decrease will come.
Decrease, yeah.
And a comment on CBX from the US market as well said that is where the rubber will hit the road. Would you agree, Dr. Forrest, that the monetary policy is going to dictate when the changes take place?
Definitely. From the demand side, you will see that investors are going to be looking more where interest rate is high. They are looking more towards high interest rate instruments. And so the stock market would not be the avenue for them to look at, despite the fact that they should be looking at the stock market to see where the bargains are, the sales are, and invest their money there. But the reality is, and what we are seeing is with high interest rate, they are looking at other instruments. So obviously what we would like to see is a reduction in interest rate, because it affects both the supply side of the market, the demand side of the market, and ultimately the overall market.
Right. Angus, one more thing on that. If the funds on the retail side and the business side are not in long-term capital investments, where is the funds? I mean, it seems here that consumers are saying they're going to leave them in commercial banks. Is that actually happening?
Yeah, so short-term money market rates are very high. So for example, your T-bill rates are at elevated rates. Those are zero risk type instruments. When you can earn 5% on a 3-month, 6-month US Treasury bill in US dollars, which in our world is the definition of academic no risk, it is going to affect the appetite for higher yielding type instruments like shares, stocks and shares, etc. So yes, the money is in money market accounts, in commercial banks. Repo rates are very elevated. Durations are very short. And I think investors are just taking advantage of this environment. And I think we won't see that change until rates start to dip downwards. Then you would see investors going out a little longer to try and hold on to today's environment.
Right. Don, the leading question now about investments again. The sectors that were indicated that they're going to do investments, did they say specifically what kind of investments? Is it, I'm looking here now at the human resource aspect. I don't remember if there's a slide that says how those businesses are going to invest. Are going to invest in infrastructure, in goods or in their staff complement, their training, etc. Because I think that is one aspect that Wayne I wanted to comment on shortly. But Don, would you say that any of those businesses looking to invest are investing in their people? Because it seems to me that everybody's screaming about jobs for young people. So is that part of the investment plans for the business?
Yes, I think one piece of the data did point to investment in human resource because they recognized that that was one of the shortcomings. To say that we can categorize them in terms of degrees of importance, I would say no, because again, the questionnaire was rather long. And therefore, I think at almost every point we could say, well, is there a qualitative evaluation that we could give? I think for future, we can look at that. But I think on this particular one, we really wouldn't be able to give you categorically what are they and how they plan to do so.
Yes, I think that would be important to say, yes, you're going to invest. What are you going to invest in?
Yes, right.
So Wayne, is there any demand? How is the demand for, for the labor force now? We hear a lot of call for the need to import labor. While we're still here saying that we need jobs for young people, on the other hand, we're also hearing calls for importation of labor, specialized labor. How do we balance that? And how is the Federation, what is the steps the Federation are taking to kind of guide that process into the future?
No, certainly there are, and historically, because Jamaica is a relatively small, open economy, competing in a global market, there are specific skill sets that we have always been short of, and it suits us to import. In recent times, as unemployment has fallen to record levels, that skills gap between the needs of businesses that want to expand, the needs to improve businesses as they are, that gap has widened. Yes, you may have young people who want better paying jobs. You hear the anecdotes of people with university degrees going to work in BPOs at relatively low wages. But the fact is that there is a skills mismatch between what the market needs now and the skills that are coming out of our formal or educators or institutions of formal education. But there's also another factor that we ought to recognize right up front: the fact that the Jamaican workforce has a 60% component with no certifiable skills, and Jamaica has chronically suffered from low productivity. I mean, among the worst in the hemisphere in terms of productivity growth. Many businesses have recognized this. And while the importation of skills, and nobody wants to import skills if they were available locally, so it's not a threat to local skills. The fact is that it is cheaper to use a Jamaican worker already domiciled here than to bring somebody in with all the requisite costs. And businesses, one thing businesses do, they are very mindful of the cost. But the fact that the cry has increased for an opening up of importation of skilled workers, bearing in mind too that we can right now, without any change in legislation, bring workers from the rest of the CSME, from the rest of the Caribbean, does speak to the need for growth and what one of the obstacles right now for growth. The question as to what businesses are investing in now, coming back to the question of productivity, while we might not say we're looking to improve productivity, recognizing that there's an upward push for wages. The retention of talented, experienced, skilled workers means that you have to pay more and have had to pay more. I touched earlier on the massive increase in public sector compensation, which has had an overall upward push on wages and has made every business owner in this country go back to the drawing board and say, what technology can we invest in? What training can we invest in? How do we improve our management system, whether to flatten the bureaucracy? All the buzzwords are now at play in terms of the investment we are making in our businesses to improve individual productivity. So the productivity can at least match the increased expectation of improved compensation.
Right. Yeah, there was a question about compensation in the chat as well. Yeah, so before we just ask all three panelists for a quick what's next, what we expect for 2024. Angus, there's a question in the chat which I'm going to ask you to take. It says that the New York Stock Exchange, which is a different market, did very well in 2023 relative to the Jamaica Stock Exchange. And the question the participant is asking is why.
So the New York Stock Exchange arguably is one of the most efficient stock exchanges that we have globally. And while the Jamaica Stock Exchange is the most liquid and probably the most efficient stock exchange that we have in the region, given its depth, its sophistication, number of issuers, trading activity, etc., there are also intrinsic inefficiencies built into the domestic environment. So let's also remember that interest rates in Jamaica are north of interest rates in the United States. So J-dollar rates are much higher than US dollar rates. And a lot of the institutions that are listed on the stock exchange in Jamaica earn J-dollars, right? And the cost of their J-dollars is something that they would have to factor in also. So there are different costs of capital across different regions. There are different inherent domestic inefficiencies built into some of the regional stock exchanges. It's not going to mirror exactly, Andre.
All right, thank you very much. All right, as we wrap up, Wayne, you're a businessman as well. What do you see? What do you expect for the rest of 2024 in terms of business and consumer confidence? Where you're seeing the growth, or what you're looking in the crystal ball and expecting to see happen?
I expect moderate growth in consumer confidence once we keep everything stable. As you know, as I noted earlier, and as the respondents in the vast majority have noted crime and violence is a concern, because I think everybody is cautiously optimistic, recognizing that a few disruptive events can really set us back significantly. So I would say cautious optimism. We are investing in the tools to improve firm and individual productivity and competitiveness. We are optimistic that Jamaicans will continue to improve in productivity, in prosperity. But we also see bottlenecks ahead. The skills gap definitely is a bottleneck and will be a brake on economic growth. And this was pointed out by the head of the Planning Institute. I think Dr. Wayne Henry made that call as early as April last year. So we see some breaks in the future if policy does not move quickly to address these issues.
Thank you. Thank you very much. Angus, from the NCB perspective now, it's the bank, the NCB capital markets. What will you guys be doing to propel the economy and to bring more confidence from your customers and from your businesses?
Sure, no problem. So I think we are facilitators of the market. We are also makers of the market. So we are poised to really have that best practice type development of clairvoyance as to where the markets will go. And we would give this advice to our clients who do have an interest in approaching the markets for capital, and to work with them to understand and explain to them when is the best timing to do so. So it would also fall back on how immediate their need is for the capital. But we are poised, given who we are, the breadth in the market, the expertise that we have, and of course our precedent of execution, to really be that clairvoyant entity who can give the best advice to clients as to when the right approach is going to come for them, and a prediction in terms of where the markets would go in the future. So by working with us, you get to leverage that experience and depth, that clairvoyance, to perfect the timing in the approach for capital, Andre.
Thank you very much, Angus. Dr. Street Forest, from the stock exchange perspective, what is your expectation and what is happening at the stock exchange? I mean, when we strategically invite you at the beginning of the year because we get a good feel for what to expect from the businesses and consumers when you are here present. So what is in the pipeline that you believe at the stock exchange will help to increase consumer and business confidence and to sort of also contribute to the growth in the economy?
Well, I believe that companies will continue to improve efficiencies. We have seen that the performance of companies are still growing despite the fact that there are challenges, despite the fact that the prices do not reflect in the growth of the businesses. But I think that those will continue. Companies, we know, we have the inside knowledge that companies are still wanting capital for growth and expansion, and that they are preparing themselves to come to market. The stock exchange itself will be there as facilitators in terms of ensuring that the companies understand how to access capital. We'll be continuing to lobby our government in terms of the various tools to allow for them to have a better position in terms of accessing that capital. Obviously, market education is important, and the stock exchange continues to push at that so that persons understand from the investor side the importance of staying the long course in terms of market and the benefits that will accrue over time in terms of investing now, not to go with a herd mentality, whereas when the prices are now going high, they're investing. So we continue to push that narrative and also to ensure that confidence grows in the market. We have done a lot of things. We have introduced the JCC direct portal, where we invite persons to take charge of their own understanding of what they have invested in, and to look at it each time to see that what they think they have invested, they have, because we know that that is important to engender investor confidence. Now, obviously, when I spoke to market education, you know, at the beginning of the year, we have the JCC Capital Markets and Investment Conference. And that again is an important event that we invite the business community, the investment community to this event so that they can set their agenda for the rest of the year, you know, so they know what is the government thinking in terms of growth and development of the capital market. What are the intermediaries thinking? Angus spoke to the fact that, you know, they invite and they are the, you know, litmus for the investor and the business community. This sets the stage. So we invite people to continue to do that, to push the market education. And the conference is one agenda, one area that sets the tone.
Thank you very much. And that is when, Dr. Forrest?
Oh, that is at the Jamaica Pegasus Hotel and January 23 to 25.
Okay. One parting last question. I see one question just popped up in the chat, Doc. Somebody wants to know when the stock exchange will be introducing short selling.
By the end of the second quarter, you know, Angus spoke about the New York Stock Exchange and the performance. And the fact is that those markets in bad times have two areas for the market to perform. It's the long and the short. In markets where there is monetary policies that could suppress the performance of the market, if you have a short and long, there is less impact. So the New York Stock Exchange would have had a condition that has long and short. In the Caribbean, what we have is the long positions. So the opportunity to short is not there. So short will be in the second quarter
of 2024.
That is correct.
Okay, thank you very much. Ladies and gentlemen, we have had a very wholesome discussion. I want to thank you all. Thank all 150 odd persons who joined us and stayed with us. Mr. Anderson, the presentation is outstanding and a lot of information there for us to chew on. As suggested, I think it would be good if we add that thing about the businesses investing, what exactly they'll be investing in, because that will guide that will guide many of us, including Angus, in terms of producing products and services for them. But really, really enjoyed the session. Congrats to your team again, Don, for the work done, and we continue to look forward to further polls like this as we continue to guide the business community and the investors as to what to do. To our sponsors, NCB, National Commercial Bank, NCB Capital Markets, it's been a long road together, and I thank you very much for all the effort and everything that you put into this partnership with the Jamaica Chamber of Commerce. Thank you, Angus, for your insight today and your excellent presentation.
Thank you.
And the whole production team, Paul Media, etc. Excellent, job well done. To Wayne Chen, bringing your perspective as a businessman and as a human resource leader. We really, really are grateful for the opportunity. And we thank you for sharing the time with us. And we really hope that from all the presentations here, that the market will benefit from the information shared. And of course, Dr. Marlene Street Forest, goes without saying, your insight and your experience has been brought to the table here once again. Thank you for your participation. Ladies and gentlemen, we do have a survey on this right after this. We ask you to stay online for a couple of minutes and just complete the survey for us so that it can help us to continue to make this product better for you. Thank you very much, everyone. Please enjoy the rest of your day.
Thank you, everyone. Be safe.
Take care.